Hey, good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Hump Day, and it's May or April 30th, almost May Day tomorrow. So, anyways, we got a bunch of economic news to go over today. We're gonna jump right into it. We got the ADP employment numbers, and so last reporting back in March, we had 202,000 new jobs were created in the private sector according to ADP. And for the month of April, it jumped up to 20,000. So we had 222,000 new jobs created for the month of April in the private sector. So good numbers there. Again, we'll get the Bureau of Labor Statistics reporting later on, uh, but at least this looks positive so far. And then we got the GDP for the first quarter. This is the first initial one. We get three of these revisions. So we'll get the first one, then next month we'll get the second revision, and then we'll get the final revision back in June. And then to know where the GDP is, or the gross domestic product. This kind of tells us where our economy is basically at. So we had 2.6% growth in the fourth quarter, and the forecast for the first quarter is supposed to be at 1%, and it dropped all the way down to 0.1%. Huge miss there, and basically that's being attributed to one of the worst weathers we've had for quite some time during the first quarter. So this is being attributed. It looks like weather is playing a huge part in our missed numbers right there, and looks like so far we've been kind of seeing a lot of that weather was probably the attributed to a lot of the down numbers that we had in the first quarter. We also got the employment cost index for the first quarter. We had a 0.5% in the previous quarter, and the forecast is supposed to continue 0.5% increase. And it only went up at 0.3%, so better. The cost of employment was lower, so that's a good thing. So it's cheaper for people to hire, so hopefully we'll create more jobs. And then we also got the Chicago PMI for the month of April. So this is the manufacturing in the Chicago region. So at a 55.9. So anything above 50 is considered expansion. 55.9 in March. The forecast is supposed to come up a little bit, 56.9. And it jumped all the way up to 63. So huge numbers out of Chicago in the month of April for the manufacturing. So great numbers there. So far, very mixed. ADP was good, Chicago PMI was good, employment cost, but that GDP which is a really big number we really kind of need to look at, because obviously we need to know where our economy is going, and that was a huge miss. So very mixed. And later today we got the FOMC meeting, or the statement later today by 11:15 Pacific Standard Time. So expect a huge, very much, maybe some volatility there. They are expected to taper the bond purchases another $10 billion. But listen for wordings, because for a while there was the interest rates, but since then, since the last FOMC meetings, there's been a lot of scheduled talks, and a lot of them have been forecasting late 2015 when they expect the rates to go up before them raising rates. So listen to the wording and see how they frame things. It'll be real important if there's any misses. So there could be a lot of more volatility from where we are currently after they make their statement. So as a result, stock market's actually a little bit mixed. It was actually down quite a bit, especially at that GDP number, and it now it's kind of getting a little bit more mixed in there and stuff. Especially that Chicago PMI kind of helped things out a little bit. The Dow was down and it kind of upticked slightly up right now. So again, we'll have to wait and see the FOMC meeting. That could easily turn things around as the Fed speaks. It's kind of like the E.F. Hutton of the financial markets. Let's go ahead and take a look at the bond market. So far, we're up today. So we got improvement in the interest rates. We're up about 12 basis points. So that's enough for a price improvement from where we left off yesterday. Again, this could easily be wiped out if the Fed makes the right statements and maybe they take all the money out of the bonds and put it into the stock market. If the stock market likes it, that's what's going to happen. We'll probably see the bond market crash a bit down further due to money being pulled out of the mortgage-backed securities and going into the equity markets. All right, so be very wary today. There could be a lot of things that could really play into either way for us, but if anything, it could be more positive. We'll see if they touch on the GDP numbers, but so far what we're seeing for second quarter, it looks like it could be a little bit more rosy, so we'll have to kind of wait and see. All right, folks, thanks for watching. I hope you guys have a great day, and we'll look forward to see you guys tomorrow.